Lifetime value is the most trusted metric in business. Every growth team tracks it. Every investor asks for it. Every marketing dashboard displays it front and center. But LTV is built on three fundamental flaws that lead to catastrophic decisions. The first flaw is that lifetime value isn't value at all. It's a guess about the future disguised as a fact. The second flaw is that it ignores the actual cost of serving customers, which means your profitability calculations are fiction. The third flaw is that blended averages hide which acquisition channels are bleeding money and which are printing it. These aren't minor measurement errors. They're strategic blind spots that cause you to scale the wrong things, ignore your best opportunities, and burn cash on growth that will never be profitable. Let me show you exactly where this metric fails and what to use instead. Flaw 1. The lifetime assumption, predicting the unpredictable. Here's the dirty secret about lifetime value. It's not measuring anything that actually happened. You're projecting future customer behavior based on historical patterns. That projection assumes your market stays stable, your competitors don't change tactics, and your product remains exactly as attractive as it is today. None of those assumptions hold in reality. When market conditions shift, your LTV calculation becomes worthless overnight. A competitor drops prices, and your retention curve collapses. You launch a new feature, and usage patterns change completely. Economic headwinds hit, and customers start churning faster than your model predicted. But the real damage happens before any of that. Companies overinvest in customer acquisition because they believe inflated future value projections. You're making today's spending decisions based on revenue you haven't earned yet and might never earn. The cohort decay problem makes this worse. Your early adopters behave completely differently than customers who join later. Early users are more engaged, more forgiving of product gaps, and more likely to stick around. But when you calculate a blended LTV, you're averaging those super users with everyone else. That average becomes your growth model. You assume every new customer will behave like your best customers did. They won't. The fix is to compress your measurement window dramatically. Instead of calculating lifetime value over 12 or 24 months, measure actual value over 60 or 90 days. L60D gives you real behavioral data, not projections. You know exactly what a customer is worth in their first 2 months. That's a fact, not a forecast. Shorter windows create faster feedback loops. You can test acquisition channels, pricing changes, and onboarding improvements and see real results within a quarter. You're not waiting a year to find out if your growth strategy actually works. The common mistake is treating 12-month LTV projections as certainties when building KOC payback models. You convince yourself that a customer will be worth $300 because your spreadsheet says so. Then you spend $100 to acquire them, confident in your 3-to-1 ratio. But if market conditions change in month 4 and half your customers churn early, you just lost money on every acquisition. The projection was confident. The outcome was a disaster. Measure what's real. Use compressed windows. Make decisions based on actual customer behavior, not optimistic forecasts about what they might do next year. But even if your LTV calculation was perfectly accurate, you're still missing half the equation. Flaw 2. The hidden cost trap. Why LTV-CAC ratios lie. The standard LTV calculation measures revenue. It does not measure profit. That distinction destroys most growth strategies because the costs of actually serving customers get ignored completely. Here's what the typical LTV formula excludes: cost of goods sold, fulfillment expenses, customer support overhead, platform fees, refunds, payment processing, and retention marketing. You're counting every dollar a customer pays you. But you're not subtracting the dollars it costs to deliver what they bought. This matters enormously when you're making scaling decisions. A 3-to-1 LTV to CAC ratio looks healthy until you realize your gross margin is only 40%. Suddenly, that $300 LTV is really $120 in gross profit. Your $100 CAC just turned a profitable customer into a break-even one. The compounding error happens when you scale based on inflated LTV numbers. You think you're scaling profitable customer segments. You're actually scaling unprofitable ones, and the faster you grow, the faster you burn cash. Calculate true LTV using gross profit, not revenue. Take every dollar of customer lifetime revenue and subtract every variable cost associated with serving that customer over the same period. The retention cost blind spot makes this even worse. LTV formulas assume it costs $0 to keep customers around. But retention marketing has real expenses. Email campaigns, loyalty programs, customer success teams, product updates to reduce churn, all of that costs money. If you're spending $50 per customer per year on retention, but your LTV calculation pretends that's free, your profitability model is off by $50 per customer. At scale, that's millions in phantom profit. Run your LTV calculation twice, once with revenue, once with gross profit after all variable costs. The gap between those two numbers reveals your actual constraint. Build a unit economics model that tracks every dollar in and out per customer cohort. You need to know exactly what it costs to acquire, serve, and retain each segment. The mistake that kills companies is celebrating high LTV numbers while burning cash because unit economics are negative at the cohort level. The dashboard looks great. The bank account tells a different story. But even with accurate profit calculations, there's one more trap that kills growth. Flaw 3. The blended average illusion. When averages hide opportunity, a single LTV number is strategically useless. It masks massive variance across acquisition channels, customer segments, and behavioral patterns. The reality is that organic search customers might have 5 times the lifetime value of paid social customers. Email subscribers might retain at twice the rate of discount affiliates. But when you blend all of that into one average, you lose the ability to see what's actually working. Blended averages hide which channels are profitable and which are being subsidized by your winners. You might have 3 acquisition sources printing money and 5 burning it, but your dashboard shows a healthy blended LTV to CAC ratio. So you keep spending across all 8 channels because the average looks good. That's the scaling trap. You hit a ceiling because you're trying to scale channels with fundamentally different unit economics. You can't 10x your marketing budget proportionally and expect the same results. The high LTV channels have natural limits. The low LTV channels will never be profitable no matter how much you optimize. Segment your LTV calculation by acquisition source, not just at the company level. Break it down by every channel, campaign, and cohort that matters. When you do this, the strategic picture changes completely. You discover that SEO traffic converts at half the rate but retains 3 times longer. Paid social drives volume but churns fast. Referrals cost nothing to acquire and have the highest LTV of any source. That insight changes everything. You double down on SEO and referral programs. You cut or restructure paid social to focus only on high-intent segments. You stop treating marketing as a blended budget and start treating it as a portfolio of bets with different expected returns. Go beyond acquisition channels. Segment by customer behavior, product mix, and geography. A customer who adopts your core feature in week 1 has different economics than one who never activates. A customer buying your premium tier has different retention than one on your entry plan. Build a dashboard that shows LTV and CAC side by side for every meaningful segment. You need to see at a glance which parts of your business are profitable and which are not. The mistake that kills growth is scaling marketing spend proportionally because blended ROI looks acceptable. You're burning money on channels that will never hit profitability at scale. The math worked when they were 10% of your budget. It breaks when they're 50%. These 3 flaws aren't just measurement errors. They're strategic blind spots that prevent you from seeing where your business actually makes money. Conclusion: the True Profitability Framework. LTV is backward-looking, cost-blind, and dangerously averaged. You need a replacement framework that measures what actually matters. The True Profitability Framework has 3 components. First, use L60D or L90D for faster, more accurate cohort measurement. Stop projecting and start measuring real behavior in compressed windows. Second, Calculate gross profit LTV by subtracting all variable costs from revenue. Know what customers are actually worth after you pay to serve them. Third, segment everything by acquisition channel and customer behavior. A single average hides your best opportunities and your biggest losses. When you implement this framework, you know exactly which growth levers are profitable and which are illusions. You stop scaling the wrong things. You start doubling down on what actually works. Your next step is to audit your current LTV calculation. Identify which of these 3 flaws is costing you the most. Fix that one first. Subscribe for more frameworks that replace conventional business metrics with strategies that actually work.